You have done the hard work, identified the undervalued asset, and watched your capital multiply. Yet right now, you might be making the most expensive mistake of your investing career. The entire financial industry obsesses over what to buy and when to buy it, but they leave you completely in the dark about the exact moment you need to walk away. We are conditioned to believe that holding on forever is the ultimate virtue of the intelligent investor, but unrealized gains are nothing more than numbers on a screen until you actually press the button to sell. That illusion of a permanent upward trajectory traps millions of ambitious wealth builders into becoming accidental bag holders when the tide inevitably turns. We must fundamentally rewire how we view our portfolios, shifting away from emotional attachment and moving toward cold, calculated execution. You are not collecting trophies to admire on a shelf. You are deploying capital as a tool, and a tool is only useful if it eventually completes the job it was hired to do. This brings us to the absolute necessity of a predefined exit strategy, which is the specific, documented plan detailing exactly under what conditions you will liquidate a position. Before you ever allocate a single dollar to a new venture or equity, you must know exactly what your target price is and what fundamental changes would invalidate your original thesis. By establishing these parameters while your mind is clear and objective, you build an impenetrable fortress against the panic and greed that will inevitably cloud your judgment later. History is brutally unforgiving to those who ignore this discipline, as we saw with devastating clarity during the dot-com bubble of the late 1990s. According to research from the National Bureau of Economic Research, countless investors watched their tech-heavy portfolios surge to astronomical valuations, only to lose up to 80% of their net worth because they lacked the framework to lock in their profits. They believed the new paradigm would last forever, completely ignoring the historical reality that all euphoric market cycles eventually face a violent regression to the mean. The widespread mantra to simply buy and hold forever is a dangerous oversimplification peddled by institutions that profit from your passive complacency. While long-term investing is a proven engine for compound interest, which is the exponential growth of your money as returns generate their own returns, blind loyalty to a single asset is a critical vulnerability. Your loyalty must belong entirely to your broader financial independence, not to a specific ticker symbol that happens to be performing well today. To master this phase of wealth creation, we have to confront the psychological terror of FOMO, or the fear of missing out. This is the agonizing anxiety that if you sell today, the asset will double again tomorrow, leaving you looking foolish while others get rich. But giving into that fear means you are no longer making strategic decisions. You are gambling on pure momentum, and momentum is the most fragile foundation you can build your financial future upon. The difference between paper wealth and generational prosperity comes down entirely to the mechanism of profit-taking. When you systematically extract your initial investment and a portion of the gains from a surging asset, you instantly eliminate the risk of a total loss while still participating in future upside. You transform a speculative position into a mathematically bulletproof victory, securing capital that can immediately be deployed into the next asymmetrical opportunity. One of the most effective tactics for executing this is scaling out, which means selling your position in predetermined fractions rather than liquidating everything in one massive transaction. You might sell 25% of your holdings when the asset doubles, another 25% if it reaches your secondary target, and leave the remainder to capture long-tail growth. This methodical approach completely neutralizes the emotional paralysis of trying to time the absolute peak of the market, which is statistically impossible to do with any consistency. Removing your ego from the transaction is the invisible threshold that separates amateur speculators from true financial strategists. You have to accept that you will almost never sell at the exact top, and you must be completely at peace with leaving some money on the table for the next participant. The goal is not to squeeze every last theoretical cent out of a trade, but to capture the meat of the move and protect your accumulated wealth from sudden reversals. Understanding broader macroeconomic environments provides the critical context for when these selling windows naturally open and close. When retail euphoria reaches a fever pitch, when your neighbors are giving you stock tips, and when institutional liquidity begins to dry up, the market is practically screaming at you to reduce your exposure. These systemic signals are far more reliable indicators for an exit than the daily fluctuations of a single company chart. This macroeconomic awareness feeds directly into the mechanical discipline of portfolio rebalancing. This is the routine process of realigning the weightings of your assets to maintain your original desired level of risk. If a massive rally causes one tech stock to suddenly comprise 40% of your entire net worth, you are no longer diversified. You are heavily concentrated and highly vulnerable. Rebalancing forces you to do what feels incredibly unnatural, which is selling your biggest winning investments and buying more of your underperforming assets. It feels like cutting your flowers to water your weeds, but according to studies by Vanguard, this systematic trimming is one of the most effective ways to control volatility and enhance long-term risk-adjusted returns. You are automatically buying low and selling high without having to rely on intuition or market timing. Many investors hesitate to execute these necessary sales because they are paralyzed by the impending capital gains taxes. While optimizing for tax efficiency is a crucial component of intelligent investing, letting the fear of a tax bill prevent you from securing a massive windfall is a catastrophic error in judgment. Paying taxes means you made a profit, and holding a deteriorating asset just to avoid the Internal Revenue Service is a guaranteed way to watch your hard-earned wealth evaporate. The capital you liberate through these strategic exits becomes the lifeblood of your expanding financial empire. Cash is not just a defensive position, it is aggressive optionality, giving you the immediate liquidity to pounce on distressed assets or fund new entrepreneurial ventures when the broader market panics. By harvesting your winners, you are effectively reloading your weapon, preparing to strike when the next major dislocation creates generational buying opportunities. We also have to dismantle the endowment effect, a cognitive bias where we overvalue an asset simply because we already own it. If you were holding $50,000 in cash today, ask yourself if you would use it to buy your current portfolio at today's exact prices. If the answer is no, then you have absolutely no logical reason to continue holding those specific assets, and your refusal to sell is based entirely on inertia. To combat this inertia, sophisticated investors utilize trailing stop losses, which are automated orders that adjust upward as the asset price increases but trigger a sale if the price drops by a specified percentage. This mechanical safeguard acts as an invisible safety net, locking in your upside trajectory while completely removing the need for daily monitoring and emotional decision-making. It is the ultimate tool for letting your winners run while enforcing a strict, uncompromising boundary against catastrophic loss. The transition from a passive accumulator to an active manager of your own wealth requires a ruthless level of objectivity. You must view your portfolio as a dynamic ecosystem where capital must constantly justify its placement, rather than a static vault where investments go to collect dust. Every single day you choose not to sell an asset, you are actively making the decision to buy it at its current valuation. Compounding your capital through a series of disciplined, sequential wins is fundamentally more robust than praying for one eternal, uninterrupted hold. When you take profits and reinvest them into new, undervalued opportunities, you are accelerating the velocity of your money and multiplying your potential points of leverage. This active reallocation is how self-made millionaires scale their net worth far beyond the limitations of a standard salary and a passive index fund. Of course, the risk of prematurely exiting a position and watching it climb another 100% is a reality you will face repeatedly. There will be moments where your strategic discipline feels like a mistake in the short term, especially when speculative manias defy all logical valuation metrics for months on end. But surviving the inevitable crashes and preserving your capital for the long game is infinitely more valuable than capturing the final, most dangerous phase of a parabolic blow-off top. Treat your investment portfolio with the exact same ruthless pragmatism as a corporate CEO managing a conglomerate of diverse businesses. If one division has peaked in its growth potential and is facing massive impending headwinds, a competent executive does not hold on to it out of sentimentality. They spin it off and redirect the capital to higher-yield projects. You are the chief executive of your own financial destiny, and firing an underperforming or overvalued asset is a core requirement of the job. As you harvest these strategic gains, you begin to construct scalable income streams that operate completely independent of your daily labor. The profits taken from a volatile tech rally can be systematically rotated into dividend-yielding equities, real estate investment trusts, or fixed-income instruments that provide reliable, compounding cash flow. You are essentially converting speculative energy into permanent financial infrastructure that will fund your lifestyle for decades to come. The ultimate flex in the modern financial arena is not riding a rocket ship to the absolute peak. It is having the supreme discipline to walk away from the casino table while the crowd is still screaming for more. It requires an immense amount of self-trust to disconnect from the collective hysteria and adhere strictly to your predetermined mathematical targets. True financial power is derived from independence of thought, not from following the herd over the edge of the cliff. During these intense run-ups, you must actively tune out the relentless noise of financial media, which thrives on sensationalism and perpetual optimism. Analysts and commentators are inherently incentivized to keep you engaged and fully invested, often upgrading their price targets at the exact moment the smart money is quietly heading for the exits. Your strategy must be dictated by your own proprietary research, your personal risk tolerance, and your specific timeline, never by the breathless headlines of a 24-hour news cycle. Write down your personal selling manifesto today, clearly defining the exact metrics, life events, and portfolio weightings that will trigger an automatic liquidation. Whether it is a specific percentage gain, a fundamental shift in a company leadership structure, or the need to fund a major entrepreneurial acquisition, having this physical document bridges the gap between abstract theory and decisive action. When the market inevitably tests your resolve, this manifesto will serve as your unwavering anchor in the storm. Mastering the strategic discipline of selling a winning investment is the definitive threshold you must cross to secure lasting, generational wealth. We are not here to chase fleeting paper valuations or to participate in the collective delusion of infinite, uninterrupted growth. By executing your exit strategy with cold precision, capturing your profits, and relentlessly reallocating your capital, you transform temporary market victories into an unbreakable foundation for absolute financial freedom.